Welcome to Chapter 22 of the Wealth Management Essentials course. In this chapter, we're going to be taking a look at some managed products. So there are quite a few learning objectives, but we will be talking about the role of managed products in investment management, mutual funds and wrap products, as well as ETFs, hedge funds, digital assets, principal protected notes, fees, portfolio turnover and taxes, overlay management, and outcome-based investments. So to start, the role of managed products. So managed products consist of mutual funds, ETFs, or any pool of capital gathered and invested in a portfolio of securities according to a specific investment mandate. It's beneficial for smaller accounts to have managed products because it does add diversification in an easy and cost-effective way. And so that was the main reason why managed products became a thing. There can also be less transaction fees for smaller portfolios because rather than buying, let's say, 10 different stocks and having a trading fee on each one of them, you just buy a managed portfolio with hundreds of different stocks and you just have to pay a management expense ratio on that. So with ETFs, there are a few different types. There is a synthetic ETF, so they do not hold the same underlying exposure as the index they track, and they are constructed with derivatives such as swaps to achieve the return effect of the index. There's also leveraged ETFs, which use derivatives such as swaps to achieve the leveraged return effect, and they are designed to achieve returns that are multiples of the performance of the underlying index they track. Inverse ETFs are constructed with derivatives such as swaps to achieve an inverse return effect, and commodity ETFs are usually based on either physical-based, future-based, or equity-based. There are a variety of different ETFs as well. You might have just a regular ETF that tracks a certain index like the S&P 500. And there are sometimes now being some more active management strategies within ETFs. Now, the risks of derivatives, leverage, or commodity ETFs. So adding derivatives to an ETF obviously increases the risk. There's the risk of roll yield loss. So it can lower the overall return of an ETF holding front month future contracts by having to buy a new contract each month. There's the risk of front running. So front running is buying or selling a security ahead of a larger trader who is buying or selling the same security. So sometimes with these derivatives, with these ETFs, they sometimes have to buy certain investments periodically each month, and sometimes you could buy ahead of a larger trader. Counterparty risk for derivatives. So ETFs that employ swaps are exposed to the counterparty risk that the other side of the swap may not be able to fulfill its obligations over the life of the contract. There's risk related to volatility and leverage factors. So inverse and leverage ETFs, actual performance has differed from expectation. So they are specifically designed for investors to only hold them over a short holding period as a hedge, and not for medium to long-term performance. There is the risk of short selling bans. Short selling was banned for a brief period in September 2008, and it did cause a dilemma for some inverse and leverage ETFs. There's credit risk in currency ETFs as well. So sometimes currency ETFs hold actual cash, which are exposed to credit risk with the bank that is holding that physical cash. Now, risks of swaps versus derivatives. So you have the counterparty risk or default risk. So swaps tend to carry far more counterparty risk because there is the risk that the person that you swapped the contract with isn't able to fulfill that obligation. Whereas with a derivative, it is a bit more liquid. It can be bought and sold on the market. Costs, so swaps are more expensive. There's tracking error, so since swap contracts are not as fungible as derivatives or liquid as derivatives, swap contracts have higher tracking errors. Flexibility, so swaps, they do tend to be a bit more flexible. And disruption of trading, so swap contracts do not have daily price fluctuation limits like future contracts. Now, there's also hedge funds. So these are often referred to as alternative investment strategies. Some hedge funds are aggressive while some are conservative. Although they are called hedge funds, this does not necessarily mean that they are hedging their positions at all. Hedge funds are targeted towards high net worth and institutional investors. And when a hedge fund is issued, they must give you an offering memorandum. Hedge funds' fees usually use a hurdle rate or a high watermark. So if that investment earns a return above that hurdle rate, then the hedge fund will make profit off of that money that is above that hurdle rate or high watermark. So hedge funds often use various different strategies. So the first one here is relative value equity strategies. So this would be like low market exposure strategies, such as equity market neutral funds. There's event-driven equity strategies, so medium market exposure strategies such as merger or arbitrage. So they're searching for companies that are potentially going to merge, or they're looking for arbitrage opportunities. Directional equity strategies, so high market exposure hedge fund strategies such as long and short equity, global macro, emerging markets, managed futures, and dedicated long or short bias. So sometimes maybe they short certain stocks in that fund to get this directional equity strategy. Relative value fixed income strategies. So this is when there's low market exposure, and it could be a strategy such as convertible arbitrage and fixed income arbitrage. So you're looking for fixed income that can be converted, and sometimes there is an arbitrage for that, and other fixed income arbitrage as well. Event-driven fixed income strategies, so again, medium market exposure, and the strategy could be distressed securities or high yield bonds. And directional fixed income strategies. These offer high market exposure strategies such as global macro, emerging markets, and managed futures. Now, there are some different factors in hedge fund allocation decisions. So volatility does not equal risk with hedge funds. Volatility does not measure that true risk of hedge funds. They are multidimensional, and they also include many other risks other than market risk. Investment policy constraints. So sometimes you need to determine if the client has portfolio constraints relating to liquidity. Hedge funds, they aren't as liquid as ETFs or mutual funds or other managed products, so that is something to keep in mind. Equity substitution. So you may reduce volatility by substituting some equity component with a relative value equity strategy. And bond substitution. So there are diversification considerations and potential for higher absolute returns by substituting a bond fund with a fixed income arbitrage fund. Next, we're going to briefly talk about digital assets and Bitcoin. So Bitcoin, it is a decentralized virtual currency that is based on the open source protocol of peer-to-peer Bitcoin computer networks. It creates a decentralized public transaction ledger known as the blockchain, on which all Bitcoin transactions are recorded. So Bitcoin's concept, it is separated into two different concepts. One is the token, which is the digital asset representing ownership in a Bitcoin. It has financial value and investors can invest in it. Now, Bitcoin with a capital B is essentially referred to as the blockchain. So it's the protocol with the distributed network or blockchain that maintains the ledger of balances of Bitcoin, the token. So Bitcoin is usually referred to, when it is a lowercase b, it's referred to as the actual token, which has the financial value. When it's a capital B, it's often referred to as the blockchain. And so how does Bitcoin work? Well, first off, you have the blockchain. So Bitcoin is powered by this open source code known as the blockchain, which creates a shared public ledger. The ledger is available to record and validate the transactions that have taken place in the past, which cannot be altered. Each transaction is a block that is chained to the code, creating a permanent record of that transaction. With Bitcoin, there are private and public keys. So a Bitcoin wallet contains a public key and a private key, which work together to allow the owner to initiate and digitally sign transactions. The private key is the Bitcoin owner's secret password. Both keys authorize transactions with the Bitcoin, which are also irreversible. Now, in terms of how to create more Bitcoin, there is Bitcoin mining. And so members of peer-to-peer Bitcoin platform independently confirm the transactions using high-speed computers through the process called Bitcoin mining. Bitcoin transactions are validated through solving mathematical formulas, typically by blockchain miners who use mining computers to confirm each transaction. Transactions are validated within 10 to 20 minutes, and once validated, they are added to the blockchain. The miners are then paid in Bitcoin for their efforts. Now, a key aspect of Bitcoin and why people feel that the value is going to continue to go up is that there is a theoretical limit or maximum limit of Bitcoin that could ever be produced, which is 21 million coins. And so as Bitcoin miners are mining for new Bitcoin and creating new Bitcoin, the amount that they're producing slowly decreases over time to a point where we'll basically be at 21 million, or not quite. It's sort of like a logarithm plateau there where you can never really reach the 21 million. And so therefore the supply of Bitcoin is limited. And that's why some people feel the value could potentially increase in the future. Now, Bitcoin as an investment. So Bitcoin's value, it is derived from its use as a medium of exchange and as a store of value. It is being considered as a separate asset class that provides diversification benefits. So right now, there aren't really too many uses for Bitcoin. There are some ways you can pay for certain things with Bitcoin, but it is a bit nuanced. So right now, it's really that store of value. People think Bitcoin may be a good investment as a hedge to inflation, but it is all quite debatable. You can purchase individual Bitcoin in a cryptocurrency wallet, but there are also Bitcoin funds and ETFs that are now becoming more available. And finally, just some skills required for successful overlay management. So one is due diligence when selecting fund managers, managing the asset allocation of the client's investments, accommodating investment policy statements, ensuring accurate performance numbers, and assessing wholesaling support. And so those are all some important things to do when you are overviewing a client's investments and recommending certain ones. You want to look at the different fund managers and their track record, the asset allocation of the different funds and how they work together for diversification. And then also just look at the investment policy statements. Quite often, a lot of these funds, they do have certain limits, so maybe they can only put 80% in the stock market, and it can't go above that limit at any point. So it's important to know that. Ensuring that the performance is accurate, and you always want to pick funds that do have pretty good performance. And then, of course, it's always helpful when the wholesaling team is able to support. So those are all the main concepts of Chapter 22. I hope you found this review helpful, and I will see you all in Chapter 23.